Hello, fellow traders. 'Tis I, the Rumpled One. Today, we're going to revisit the daily Wick zone. It's one of my latest methods or systems that I developed. And let's just take a look at how it's performing. Because I know there's those doubters out there, all the detractors and haters. They say it doesn't work. Let's just see for ourselves. One thing you'll notice is I've made some upgrades, put in a panel or shaded area so the indicator stands out a little bit more. We can see that this is the upper Wick zone, because if you scrunch it down you can see here's the lower Wick zone. And if you look at the gauge, you can see right here, these are the bias. H1 right now says only trade short, D1 says only trade short, but W1, because the current price is above the weekly open, says only trade long. And since we have the training wheels turned on, it says do not enter the trade. So what this does is it makes sure you only trade with the hourly, daily, and weekly bias in agreement. So right here, when price broke this line, right here was the trade of the day. Now, you may have only gotten about 10 pips or so, because let's see, it hit a high of 1.3886. and you should have gotten in at 38.75. That's 10 pips, 11 pips if you got out at the high. Of course, you have to subtract a couple for the spread, depending on when and how you enter. But the fact of the matter is it's a profitable trade. You can see here we're just using horizontal lines, and we're going to trade with the bias. Some people call it trend, but to me, the trend only exists in the mind of the trader. But the bias is true, because if the price is above the open, then the bias is up. If the price is below the open, then the bias is down for that time period. And so here we're looking at 3, hourly, daily, weekly. And it's pretty much that simple of a trade. You don't have to think about it, you just have to watch, and right here is where you enter the trade. Now, do you need the daily Wick zone indicator? Well, no, because if you want to plot by hand, yesterday's high, yesterday's close, yesterday's open, and yesterday's low, you can. You could put those horizontal lines on the chart yourself, but the indicator just makes it nice. But what we see is this area, you could think of it as a breakout box. So we want price to go in the box, because we know through statistics running the frequency distributions that price is going to leave this box about 75% of the time. 3 out of 4 times price will leave the box. But let's say you don't have that, and all you have is the sweet spots gold indicator. Well, you can see here price got between these two lines, and there was a little short here, then there was a long. Price came back in here, and you can see if you were going to trade with the weekly bias, you would trade long at these lines. Okay, you don't want to go against the bias, especially if you're a new trader. It just works out better that way. Of course, somebody would argue, well, look, you could have taken that short. Well, what if you had taken it short here? Would you have stopped out? Or what if you would have taken it short here? Would you have stopped out? So you see, taking it in only one direction, the weekly bias, let that be your guide. And when the hourly and daily agree with it, you've got a pretty strong trade. But once again, these are just a horizontal line trade. Whether or not you use the daily wick zone, or if you just use the sweet spots, you can do the exact same thing. Because once price gets between two lines, chances are it's not going to stay between those two lines. It's just that simple. So remember, traders, it's not what you trade, it's how you trade it. The Rumple One, signing off.